Hello, thanks for joining today's webcast, Pain Relief for next April 15th. My name is Carole Foos. I'm a CPA and a principal at OJM Group. We're glad you could join us. We do have a disclaimer for you to take a look at on the screen. As many of you know, we are an SEC registered investment advisory firm. And so as part of that, we certainly don't want you to consider this webcast to be investment advice. In addition to that, we're not a law firm or an accounting firm, so any topics that we discuss today, we would certainly want you to discuss with your personal tax advisor before implementing any strategies that we talk about. And in addition to our disclaimers, we want you to know that as a thank you for joining our webcast, we will show you at the end of the webcast how to get some of the free materials that you see on the screen. There are several books that you can see that our principals have written. And you can get one of those to learn more about the topics that we're going to discuss. So what we want to talk about today is how you can probably be a little happier April 15th, 2016 than maybe you are on April 15th, 2015. You know, we are at a point in the history of our country where we're experiencing the highest taxes we've experienced over the last 30 years. Many of you are now seeing a 50% plus marginal income tax. You know, you might live in high state income tax states. You might see some significant local income taxes depending on what city you live in. And the highest federal income tax rate is now 39.6%. with an additional 3.8% tax on much of your income via the Medicare tax, the net investment income tax, or the Affordable Care Act surtax. So tax rates are now at least 45 to 55%, again, depending on your locality. Total taxes on long-term capital gains and dividends can now reach 23 to 35%. And so tax planning really has not been as important in 30 years as it is today. Certainly, one of your top goals might be to reduce your taxable income in 2015. There are a lot of ways that you can consider reducing that income. If you've got the ability to defer income into a deferred compensation plan, that makes a lot of sense in these high tax rate environments. If you have stock options as a piece of your compensation package, you might want to defer the exercise of those options in order to defer income. Funding a qualified retirement plan is certainly a great way to reduce taxable income. You know, safe harbor 401k plans do have to be established by October 1st of this year in order to implement them this year and get a deduction. Non-safe harbor plans just need to be established by the end of the year, by December 31st. But certainly qualified retirement plan funding can be a big ticket item in tax reduction. If you already have a qualified retirement plan, it might make sense to evaluate that plan and see if there's a way to get more money into it. Deferring billings and collections and accelerating the expenses in your business, if your business is a cash basis taxpayer, can make a lot of sense, especially if you're in that top income tax bracket. You know, if you collect revenue in January versus at the end of December, you're not paying tax on that revenue until the next tax year if you're a cash basis taxpayer. If you've got losses in your business that you have not yet realized, it might make sense to realize those losses this year. On a personal standpoint, charitable contribution planning is really important again. Doing things such as charitable lead trust and charitable annuity trust can make sense, can get you a tax deduction for your charitable contribution and help you fund your favorite charities into the future. And then, again, accelerating deductions at the personal level can also help reduce that taxable income. Doing things like prepaying your state income taxes by December 31st, paying real estate taxes by the end of the year, making your charitable contributions. All of these things will reduce your taxable income, presuming that there's not an alternative minimum tax impact. And that would be something you want to talk to your CPA about, because if you are in an alternative minimum tax situation, prepaying state income taxes and real estate taxes might not be beneficial for you. Tax diversification is one of the concepts that we at OJM Group talk to our clients about a lot. You know, many of you think about having diversification in your investment portfolio, the concept of not having all your eggs in one basket. Well, there's also diversification of your income streams from a tax standpoint. And as you can see on the chart on the screen, there are really three buckets of income. So those assets in qualified plans, such as your 401k and pension plans that I mentioned earlier, are shown in the green bucket. And if we consider that you're in a 50% tax rate when taking into account federal and state income taxes, withdrawing $100,000 out of that bucket is only going to net you $50,000 on an after-tax basis. Assets in the orange bucket, which are your investment assets outside of your qualified plan, things that you've invested in such as real estate, your brokerage accounts, are generally taxed at capital gains tax rates. And if we presume that your rate with state income taxes is going to be 30.4%, then that same $100,000 withdrawal out of that bucket will net you just shy of $70,000 on an after-tax basis. And then the blue bucket is overlooked assets. These are assets that are tax exempt. Things like municipal bonds, Roth IRAs, cash value life insurance, and life insurance retirement plans are generally tax-free. So the $100,000 withdrawal out of that bucket is still $100,000 in your pocket. So what we would say is make sure that in building your wealth, you're putting money in each of these three buckets. That does act as a good hedge against future tax rate increases. It's also really important to have tax-efficient investing. So whether you have an investment advisor who manages your portfolio or whether you do it yourself, our investment advisors here at OJM would tell you that making sure you've got an efficient portfolio, meaning having your income earning assets in your qualified plan, because as those assets generate income year after year, that income isn't being taxed until you take distributions out of your plan. And then having growth assets and tax-exempt assets in your taxable account, because again, those assets aren't generating taxable income year in and year out. It's important to time the disposition of your assets in order to receive long-term capital gain treatment. So if you're considering selling an investment, from a tax standpoint, it's certainly more beneficial to hold that investment for 12 months in order to get long-term capital gains tax rates versus ordinary income tax rates. You want to be harvesting capital losses against capital gains each year. So if you've realized some gains this tax year and you've also got some investments which are in a loss position, it might make sense to sell those assets at a loss and take the loss this year in order to offset your capital gains. You do need to be aware that If you sell an asset at a loss and reinvest in the same or substantially similar asset within 30 days, that loss will be disallowed under the wash sale rules. If you have passive investments, such as rental real estate, where you have unused passive losses, then it's important for you to consider investment strategies that generate passive income, as that passive income will first offset any of those unused passive losses before it has a current tax impact. For those of you who have children and are saving for college funding, take advantage of Section 529 plans. In many states, those 529 plans contributions can get you a state income tax deduction. And in addition to that, the income earned within a 529 plan is tax deferred, and distributions out of that plan will be tax-free as long as they're used for qualified higher education expenses. One other note in terms of just investment topics for tax, you should be aware of the reporting requirements if you have foreign accounts. So if you have any accounts in a foreign country, just make sure your CPA knows about that, as you might have some additional reporting on your tax returns. It's also important in trying to reduce your taxable income and reduce your taxes to make sure you're operating in an ideal corporate structure. So if your business is taxed as a single member LLC, you might want to consider converting to an S corporation in 2015. An active shareholder in an S corporation who provides services to that S corporation must take out reasonable compensation in the form of W-2 wages, but you can also receive distributions of profits that aren't subject to the Medicare tax. So as long as you're taking reasonable compensation, you can benefit from the profits of the company and not have that subject to Medicare tax. It's also important to maximize all types of benefit plans, whether that be fringe benefit plans, Section 162 bonus plans, or qualified and non-qualified plans. Different types of corporate structures can utilize different types of benefit plans. And it might make sense to consider a multiple entity structure for both tax planning and asset protection. And you can see on the screen in this example, we've shown a medical practice with multiple entities. But really any business might want to separate out divisions of the business and have multiple entities and have those entities taxed in different ways. Keep in mind that these entities that might have different types of benefit plans in each entity are still subject to the controlled group rules and the affiliated service rules. So any of those benefits that you're putting into place have to be offered to all the employees of all of the entities if you are a controlled group or an affiliated service group. So in summary, in terms of how to ease the pain for your 2015 tax bill, you want to look at tax reduction strategies. You want to consider tax diversification for the long term, having your income streams in various buckets. You want to make sure you are managing your investments with a focus on the tax drag, and also ensure that you have the appropriate corporate structure, which may for you be a multi-entity structure. You can see on the screen the various ways that OJM works with our clients. We have experts in asset protection, in tax reduction. We deal with corporate structure issues, benefit planning, retirement planning, insurance, and wealth management and investment advice. We are a fee-based consulting firm, and we do have clients in most states in the country. We do both business and personal planning for our clients. And our firm commitment is that if you are a qualified client, we will either show you 200% of your engagement fee in various savings, or we'll refund the fee. So we think that's relatively unique. Next steps, you can get a free copy of For Doctors Only or for our Fortune Building book for business owners and entrepreneurs, or any of our other books that we referenced earlier. We'd also be happy to have a free consultation with you. You can contact me, Carole Foos, CPA, at the number listed on the screen or at the email address. And to receive your free book or an e-book for Kindle or iPad, you can visit our OJM bookstore. The email address is there on the screen, and there's a promotional code WEB0415 at checkout. So we hope that you'll utilize those resources and schedule a consultation with us. We look forward to talking to you. And again, thanks for joining the webcast today.